Hi all. Today we are going to discuss another accounting standard known as IFRS 15, that is revenue from contract with customers. So we all know without revenue, a business cannot survive. So generating revenue would be the focal point of an organization. So moving straight into the standard, let's first discuss on what is a revenue. Revenue is an income that is generated by an organization from its business operation. So see, when you see a financial statement, specifically in the statement of profit and loss, you can see the highest amount is the revenue that is generated. So, but if you look to the bottom or to the net profit, you cannot see that is the highest amount, because net profit we will arrive when we deduct the direct expenses as well as the operating expenses. Then we will arrive at the net profit. So please don't mix up with what is a revenue and the net profit. So moving forward, in order to recognize a revenue, we need to understand a 5-step rule that has to be met or need to be considered before we recognize the revenue in the books of account. So I will list out first and then we can discuss in detail moving forward. So first one is we need to identify the contract, and then we need to identify the performance obligation. So this performance obligation would be the obligation that is performed by the selling entity to satisfy the condition that is existed in the contract. And the third point is we need to determine the transaction price. Transaction price would be the consideration for the performance obligation. And the fourth point is we need to allocate transaction price to performance obligation. So maybe in a contract, there are more than one performance obligation. So we need to allocate the transaction price proportionately to the performance obligations. And last point is the fifth step is we need to recognize revenue as or when the performance obligation is satisfied. So these are the 5 main steps that we need to have a very good understanding, in-depth understanding when we are recognizing a revenue in the books of account. Okay. Because we all know that the management, so as a thing you are as a accountant. So for an accountant, should be the main accounting standard. You need to have a in-depth knowledge, because while you send the financial statement for an auditing, the auditor will be very thoroughly check the revenue. Because why they thoroughly check the revenue? Because the revenue has a high chance of making material misstatement. So we can see a lot of cases where the revenue is misstated. Why we misstate the revenue? We will try to overstate the revenue to obtain a bonus, or in only when the revenue is higher, the shareholders will invest money. So they will try to misstate the financial statement, particularly in the revenue. So as an accountant, you should be able to have a very good understanding about how to account the revenue. So without waiting more time, we can move to the explanation of our 5 steps. First one is we need to identify the contract. So what is a contract? Contract is an agreement between 2 or more parties that create enforceable right and obligation. So see a contract. So for example, I will give you an example. See, you enter into an agreement to purchase a land. That is a contract. Also, if you enter into a retail shop and you purchase a pack of pencil. For this pack of pencil, there is an implied contract. It is not written, but if you purchase a land with a contract, it is written. So a contract can be implied as well as written. And the standard say here is a contract need to meet below criteria to account for revenue recognition. So, in order to identify this contract has the ability to generate revenue, we need to see below criteria. Below four criteria, we need to check in a contract in order to generate revenue. So the criteria are the parties have agreed the contract and each party's right can be identified. See, in the same example we discussed, when you enter into a agreement to purchase a piece of land, so in that in the agreement, you can see two parties. One is you are going to purchase and the other party is selling it. So both the parties should have approved the contract. So how we can see a contract is approved? Because in the agreement, we can see the signature of both the parties. And both the parties' right can be identified. What is your right? Your right to purchase that land. The other party's right is to sell the land to us. You got the point? Okay. So the next one is the payment terms can be identified. See, in the contract itself, we should be able to understand what the payment terms. The payment terms can be in the term of, we can make the purchase of land with the cash payment, or we can exchange the land with other properties. So that kind of payment terms can be identified. If you're an organization, they can purchase a land by transferring our company's shares. So such kind of payment terms can be identified in the contract itself. And the third one is contract has commercial subject. So what is a commercial substance? There should be a consideration for the purchase. For any purchase, there should be a consideration. There is no free of cost for the purchase. So there should be a commercial substance in the contract. And the fourth one is it is probable that the selling entity will receive consideration. See, so we are purchasing that the other party should have a more than 50% chance that the selling entity will receive the consideration. So if all these four criteria has been met, then we can take that contract for the revenue recognition. I believe you all got the understanding of how we can identify a contract. Okay, moving to the second step, that is to identify the performance obligation. See, a performance obligation means a promise to transfer goods or service to a customer. So it's a promise that made by the seller to transfer a good or service to a customer. So also the standard says we need to identify each transfer of distinct goods or service as a performance obligation. So in detail, in a contract, we can find more than one performance obligation. I will give you an example. See, you purchase a software for your company, but this software needs to be upgraded or need to be serviced by a service team. So we can see two performance obligation in here. There is a purchase of the software and the upgradation. So we can see two performance obligation. So the standard says is that we need to separately identify these two performance obligation distinctly. And the revenue also should be accounted distinctly. Moving forward in the consideration payable to customer, in the consideration payable to customer, in this portion, we will see an example which is directly related to our third point, our second point, identify the performance obligation. So moving, so we will get a better understanding when we do that question. I will get back to this point when we do that example. Okay. So moving to the third point, determine the transaction price. See, here we will need to identify the transaction price. This transaction price is the revenue. Okay. So we need to identify the transaction price is the amount of consideration that the selling entity entitled to receive once the performance obligation satisfies. Okay, that is the transfer of goods or services. So in an organization, when they satisfies the performance obligation, they need to determine the transaction price also that need to be accounted in the books of account. So the standard says 4 different effects that we need to have an understanding while recognizing the transaction price. Those were variable consideration, existence of a financial component, non-cash consideration, and the fourth one is the consideration payable to customers. So we should have a good percentage of idea when we determine the transaction price. So in explanation, what is a variable consideration? So a variable consideration, if a contract includes a variable consideration, such as a bonus or a penalty, then the business organization must estimate the amount it expected to receive. So I will give you an example. See, it's a contract for a construction of manufacturing plant. So in the contract itself, the contract is a period of 2 years. So in the contract, it has been said that if you are able to complete the construction of the manufacturing plant without compromising on the quality, they will receive a bonus. Okay, so this is kind of a variable consideration. And the standard also says that this estimation of variable consideration should only be included in the transaction price if it is highly probable that it will be received. So when the start of the contract or in after 6 months, they came to the construction team came to understand that they will be able to completely construct the manufacturing plant within 1 year, then they can account that bonus also into revenue. So let's see one example which relates to variable consideration, then you will get a better understanding. See, on 1st Jan 20x6, ABC company enters payable service provider 2-year contract with a customer. The contract price is 1 million, and in addition, customer will pay additional 0.2 million of the number of errors if the number of errors falls below the set threshold. Let me give you details about the question. The ABC company enters into a payroll service, and it is for a 2-year contract. And the contract price is one year. And they say they will pay additional 0.2 million if the number of errors while providing the service is below the set threshold. And the requirement is determine the transaction price in below cases. For the first case is ABC has little experience over this type of work, and unsure about the bonus target will be achieved or not. So here we don't have the probability that the ABC company will achieve the lowest level of errors. So what do we do? We can only recognize 1 million as the revenue. So if you see the second, ABC company has extensive experience over this type of work and consider bonus will be achieved. So there is a high chance of probability that they will receive the bonus. So what they can do, they can recognize the revenue of 1.2 million in the books of account. Okay. I believe you got the understanding about what a variable consideration is. So we can move to the second one, that is the existence of financial component. So what is a financing component? A financing component happens when the customer pay the consideration in more than a year after receiving the goods or services. Then the consideration need to be discounted to present value using the rate at which the customer borrows the money. Okay, I will give you the understanding. So a business organization sold a product to the customer, but the customer will only pay the consideration or the revenue after 2 years. So there is a time gap of 2 years for recognizing the revenue. So if you say, see, uh, so today we have in my hand I have $100. Would the for $100 I can get 1 kg of sugar. See, after 1 year, would I get 1 kg of sugar with the same money? No. There is a depreciation in the time in the value of the money. That is the time value of money. So the value of the money will depreciate each year. So what we have to do? So this problem is resolved by when we use the discounted value. So the standard says is, even though it is going to be received after 2 years, we need to discount that amount to the present value, that is by today, and then we can recognize it. And in each year, and see, very important, and in each year, that amount, so if a contract period of 2 years, in this 2 years, this amount of discounted amount need to be compounded to the final amount. Okay, see one, so it may be, when you hear this, it will be difficult to you. Once we do this question 2, we will get very good understanding. So let's move to the Excel. See, let me read out the question. The code company sold goods to L company on 1st Jan 20x2 for 200,000. Payable on 31st December 20x3. See the timing difference too. They sold on 1st Jan 20x2 and is payable on 31st December 20x3. And the L company cannot return back the good. So they cannot return back the good. And the relevant discount rate is 6%. They also gave us the percentage. And also we can see the requirement. What amount of revenue, that is first one, and finance income should be recognized in the code company's statement of profit and loss for the year ended 31st December 20x2. So here we have two requirements that we need to find the revenue as well as the financing income. So I told you we need to compound the discounted amount to the contract value. So how we will be compound this? For each year, we need to compound it with the same 6% that we used for the discounting. So in solution, see, what is the contract amount that we are going to receive after 2 years? After 2 years, we will receive an amount of 200,000. So what we have to do? We need to discount the value to present value. That is at 1st Jan 20x2, what will be the amount? So I believe you all have the understanding of the formula about how we can do the discounting. No worries, we can see here discounting formula. See in below, see the formula would be that principal value into 1 divided by 1 plus the rate, the discounting rate, close bracket, raised to the period of time, that is n. So P is principal, R is rate, N is time period. So let's input this formula to our scenario. So equal to the principal amount multiplied to 1 divided by open bracket 1 plus 0.06 close bracket raised to our time period is 2 years. So see, this is our present value. This present value should be accounted as revenue in 1st Jan 20x2. That will be the revenue. And next one, what we need to find? The finance cost. Not finance cost, it is finance income because it's a revenue. So what will be that? Equal to, so at the year end, finance cost at 31st December 20 x2 it will be equal to our same that opening amount into 0.06, that is 6%. Our 10,679 would be our income for 20x2. And what about 20x3? It will be equal to bracket open, our opening principal plus the 20x2 income multiplied by 0.06, that is the percentage. So see, if we add the bold 3 at the end, how much will be the revenue? Equal to our initial revenue plus our finance income, both here, how much will be the amount? 200. See, our revenue is 200. It is exactly matching. Or will be compounded revenue. See, on the first year, you need to recognize the revenue of this much, and the remaining 2 years, we need to recognize this much finance income. I believe you got the idea about how we can determine the transaction price when there is a financing component. Got it? Okay. Then moving to the third point in relation to finance income. That is non-cash consideration. If the consideration for the goods or service in terms of non-cash consideration, it should be measured at fair value. See for an example, in our same example for the construction of manufacturing plant, see what about the customer give a non-cash such as an asset or a share as a consideration. So what will you do? You need to recognize that asset or the share at its fair value. That is what here saying. If the transaction price is in terms of non-cash consideration, that is in terms of asset like a PPE or a share or a debt, that need to be recognized at fair value. And what the standard says is, once we initially measured it as fair value, subsequently this PPE, if the consideration is a PPE, that PPE need to be subsequently accounted as IAS 16. And we have already discussed what is an IAS 16 in our previous episode. You can see that is in our playlist. And if the non-cash consideration in terms of shares, then initially we need to recognize it as fair value. Then later, subsequently, it should be accounted under IFRS 9. This IFRS 9, we will learn in depth in coming episode. So for now, you need to keep in mind this fair value is the market value. And whenever you try to do the exam, in the question itself, we will get the what is the fair value amount is called. So I believe you got a very good understanding about what is a non-cash consideration. The non-cash consideration, if the consideration is not in the term of cash, that is in terms of PPE or in terms of shares or debentures, we can account the consideration at its fair value. Got it? And then we move to the fourth point in relation to determining the transaction price. That is, for example, an example for this type of consideration includes discount, rebate, or refund on goods or services provided by the entity, and is also not in exchange of distinct goods or services, then we need to reduce it from the transaction price. To explain it, see if there is a chance that the supplier pays to the customers. So you will find it difficult. Why? When do the customer will get a payment? Because once the supplier provides their performance obligation, the customer should pay, not the supplier should pay. But there are possibility such as when the supplier provide discount, rebate, or refund for the goods or services provided. In such cases, and also if this is not a distinct goods or services, we need to reduce that discount from our transaction price. This is also a possibility of determining the transaction price. We can do one more example. So you will get a very good understanding about what is the consideration payable to customer. See, I told you in here, when we discuss the second step in the IFRS 15, we will come across an example. That is this question, that in relation to consideration payable to customer. Let's move to the Excel. In question 3, let me read out the question. Tableau company supplies laptop computers to large businesses. On 1st July 20X5, Tableau company enters into a contract with Trill company, under which Trill company was to purchase laptop at 500 per unit. So this is the purchase price per unit. And the contract state that if Trill company purchase more than 500 laptops, there's a condition. In a year, the price per unit is reduced retrospectively to 450. See, not prospectively. The question says retrospectively from previous year onwards, previous stage onwards, to 450 per unit. And the Tableau's year end is 30th June. So 30th June is the year end. So we have two scenarios. At 30th September 20X5, Trill company had bought 70 laptops from Tableau, and the Tableau company therefore estimated that the Trill company's purchase would not exceed 500 in the year to 30th June 20X6, and the Trill company determined therefore not be entitled to the volume discount. Let's also move to the second scenario. During the quarter 31st December 20X5, that would be the second quarter of the year, Trill company expanded rapidly as a result of substantial acquisition. So let's move to the second one. Trill company during the quarter 30th. So we can also see the second scenario. During the quarter ended 31st December 20X5, Trill company expanded rapidly as a result of substantial acquisition and purchased an additional 250 laptops from Tableau company. And the Tableau company then estimated that the Trill company purchase would exceed the threshold for the volume discount in the year to 30th June 20X6. So they determined that before the year end, they will purchase more than 500 laptops. Then they can give the discount of $50 per unit. So requirement is calculate the revenue Tableau company would recognize in quarter ended 30th September 20X5. That is the first quarter. So we can determine the revenue as for the quarter ended . quarter under 30th September 20x5 30th September 20x5 what the per unit price is 500 into how many laptops they buy? 70. So how much is the amount? 35,000 would be the revenue that we need to be recognized for the first quarter ended 30th September 20x5. And the second requirement is we need to determine the revenue for the second quarter ended 31st December 20x5. So the quarter ended 30th 31st December 20x5. What will be the amount? We need to add this 35 because that is the first quarter. We come to the second quarter. So we need to, for now, we need to calculate the revenue generated for 6 months, not the 3 months. We need to calculate revenue for the 6 month that is ended in 31st December 20x5. So we need to add the first quarter revenue plus the second quarter, how much they purchased, 250 laptops into how much is the amount? See, they estimated the threshold for the volume discount they will achieve. That is more than 500 laptops they will purchase before the year end. So we can use the price discount of 450. See, our answer is 147,500. Do you agree with me? Do you agree with me on this answer? If you agree with me, you are wrong. Because see, in the question, we have seen a word called retrospectively. That means from the previous stage onwards, we need to change if something happens here. See, so what we need to do? We need to reduce that 50 from the 70 laptops. So the reduction in transaction price be equal to 70 laptop into 500 minus 450. What will be the amount? Equal to quarter under 30th December 2015 minus the 3,500. And this will be the revenue recognized for 31st December 20x5. You agree with me? This would be our revenue. I believe you all got the idea about how when the consideration payable back to the customer happens. Okay, then we come to the end of how to determine the transaction price. We have seen the variable consideration. That means if in the future of the contract, when we determine there will be a bonus or something, when the contract is completed within 1 year or something, they will provide an extra additional payment. That kind of variable consideration we need to consider into while determining the transaction price. And the second one is the existence of financing component. This financial component is when there is a time gap between the consideration received and the revenue recognized. So we need to discount the consideration that going to be received in the future to the present value, and then we need to compound to the end year of the contract. So each year there will be finance income. So that we have did one example also that you will get a better understanding. And then we have the non-cash consideration. For example, after satisfaction of the performance obligation, they receive the consideration in terms of a PPE or in terms of shares. Then we need to recognize the revenue at the fair value as an initial measurement, and that consideration of non-cash item need to be subsequently recognized in terms of IAS 16, that is property, plant and equipment, or in IFRS 9 if it is a share or financing instrument. Got it? Moving on to our fourth point in the 5-step rule, that is allocate transaction price to performance obligation. So we have covered the transaction price and the performance obligation. So in this point, what we are trying to do is we need to proportionally allocate the transaction price to performance obligation. Like I explained in the second point, we have different distinct performance obligation in a single contract. So let's move to the fourth point. When that is allocate transaction price to performance obligation. So this happens when a contract contain more than one performance obligation, then the entity allocates the transaction price to performance obligation in proportion to the standalone selling price of a good or service. See, so whenever in a contract, in a revenue consideration contract, if there is more than one performance obligation, then we need to understand or determine the standalone price of that performance obligation, each performance obligation separately, and then we need to recognize the revenue by giving weightage to the weightage based on the standalone price. For this one, when we do the example, you will get the better understanding. Moving on to the question 4. Let me read out the question first. A mobile company, Delta company, gives customer a free handset when they sign a 2-year contract. See the period of the contract, 2-year contract. For the provision of network service, for providing the network service, they have signed a contract. And also they get one free handset. And the next line is the handset has a standalone price of $100 and the contract is 20 per month. See, we can clearly identify two performance obligations. That is the handset and then the contract. That is service providing contract. And the requirement is allocate the transaction price between the handset and the network service contract. So first what we need to do? We need to determine the transaction price. Transaction price is, how much is the transaction price? So we have a contract period of 2 years. So they said per month it is $20. So we have 2 years, to 2 into 12 months into 20 per month. So our so our amount is 480 would be our transaction price. And then what the standard is saying, we see here the second line, we need to allocate transaction price to performance obligation in proportion to the standalone selling price of the goods or services. And the second one, what we need to do? We need to identify the standalone selling price. So what is the standalone selling price of free handset? It is $100. What is the standalone selling price of the service? That is the same 480 itself. Why? You will get confused now. Why it's the same 480? Because in the what they are giving in the same service at the cost of network service itself, they're giving free handset. So the standalone selling price of the service is also same as 480. So next, what we need to do? We need to allocate the revenue based on the standalone selling price. So for that, what we can do, because in total, if you see equal to, if we identify the revenue based on the standalone price, the amount will be 580. But do we have the provision of recognizing a revenue of 580? No. Because as per the contract, we are only getting 20 per month. So what we need to do? We need to give up the weightage based on the standalone selling price. Non selling price. So how much will be? So formula is equal to. So first we can find out answer equal to 100 multiplied by. So we should not multiply. We need to divide this amount. 100 divided by 100 plus 480. Now we will be having 0.17 as the weightage of answer, and then we need to find for the service equal to 480 divided by 480 plus 100. See the weightage. How much will be the weightage here? Equal to 0.82 plus 0.82 plus 0.17. See 100. You will have 100% here. See, I will give you the formula 100. See, we will have 100% in total. So how do we recognize the revenue? So this will be the weightage, and the revenue will be for handset. How much it is? 17% into what is our contract price? That is the transaction price is 480. What about the service? It will be 83% into 480. See, our revenue split. For handset, you need to recognize a revenue of 83, and for service, you need to recognize a revenue of 397. See, so this is what happened in real sense. So you might, so I think all of your doubt regarding the television or the dish service, when they provide the network services, they will provide us the modem or the set-top box to us in free of cost, but they will charge for monthly for the service they are providing for the television connection. So you will see, oh, that is very, very liberal from their side, that they are providing free of cost for the set-top box. But this is not what actually happening in the background. See what is happening? We are, for each performance obligation, we are recognizing revenue. See, separately for each performance obligation. Got it? Moving to our notes. Then we have covered the fourth point also. And then finally, we will come to the fifth point, that is recognize revenue as or when the performance obligation is satisfied. Here, in this step, we will see the technical part of the accounting treatment and all the calculation and all, that it is very crucial for us to understand or to understand how the revenue is recognized as or when the performance obligation is satisfied. So the standard says is revenue is recognized as or when the performance obligation satisfies. That we have already discussed, but that is by transferring the promised goods or service to customers. And what they are saying, the transfer means control of the goods or services obtained by the customers. See, our main obligation as a service provider, we need to provide service, or as a seller of product, we need to sell the product to the customer. So when our performance obligation is complete or it is satisfied, when the control of our product has been transferred to the customer. So if you sell a bicycle to a customer, when the customer has the possession of that bicycle, then the control is transferred from our hand to the customer's hand. So customer will have the obligation of its reward and all the liability they have to be met. So what is in conclusion of when the reward and liability is in the hand of the customer? The control has been moved from our hand to the customer hand. So then only we will identify, okay, the performance obligation has been satisfied. And that in that moment, we can recognize the revenue. And the standard says at the inception of the contract. So it's all part of a contract, like in implied contract or it's a written contract that we have discussed initially. At the inception of the contract itself, we need to identify when the performance obligation is satisfied. The standard says two different cases of performance obligation satisfaction. That is satisfied over a time or at a point in time. So they are saying an example of satisfied over time is when there is a construction of an asset, or for example, construction of a manufacturing plant. And also at a point in time, like we discussed, when the retailer sell a bicycle to a customer, that is goods being delivered to a customer. So we need to understand very clearly how a revenue is recognized, satisfied over a time, and also at a point in time. At a point in time, it is very easy for us to understand when it is same like when we enter a shop to purchase a pack of pencil or a sheet or something from the retail shop. That is the at a point in time. Or when we purchase a car from a showroom, whenever they give the car to us in a service agreement, in the sale agreement, that is a point in time when this make the sale. And in the same, at that point itself, the organization can recognize the revenue. But in case of construction of an asset, or for example, construction of a manufacturing plant, a bridge, or a building, they need to, because the construction period is more than 1 year. So in such cases, we need to identify we can only recognize the revenue based on how much we satisfied over the period of time. So see, it is regarding the satisfied over time. What they're saying, we need to see if the following criteria are met. That is, these three criteria has been met to see if the performance obligation is satisfied over time. And that first one is when the customer simultaneously receive and consume the benefit from the entity's performance. See, like in our example, when they construct the manufacturing plant, the customer simultaneously receives and consumes the benefit from the entity's performance. If we are the construction company, all the activities what we are doing, the customer is simultaneously receiving and consuming the benefit, because they can already use the manufacturing space for their own benefit, and also it has been built for their intended use. And the second point is entity is creating or enhancing asset controlled by the customer. See, the manufacturing plant is in the control of customer, but we are creating and enhancing asset which is in the control of them, which is not in our control. It is still in control of customer. We are enhancing it. And the third one is the entity cannot use the asset for an alternative purpose, and the entity can demand payment for the performance to date. What they're saying is, if the manufacturing plant that we are constructing, that we cannot, as a construction company, we cannot use that manufacturing plant for any alternative purpose, because we are specifically building for our customers' purpose. We cannot take it to alternative purpose because it is also in the control of customer. And the entity can, and the second one is the entity can demand payment for its performance to date. And it is saying that whenever date how much the entity or the construction company did the work, they can demand payment to date. So if all these three or any one of these three has been met, then we can we can identify the performance obligation as satisfied over time. Moving to the accounting treatment for our two different method of recognizing revenue, that is satisfied at a point in time and satisfied over time. So how we can recognize revenue that is satisfied at a point of time? That is revenue recognized at the fair value or the market value at the time the control transfer, like we discussed above. When you go into showroom for a purchase of a vehicle, whenever they hand over the key and all the relevant sale document, at that point itself, the car company can recognize the revenue of the sale of that car. That is what the standard is saying. At the point in time itself, we can recognize the revenue at the fair value. And the second one is satisfied over time. That is our construction of the plant or bridge or whatever the construction that take place over more than 1 year, and any of this condition has been met. Then we can say it is satisfied over time. So in such case, revenue is recognized based on the progress towards its completion. So what a construction company can do, whatever the progress they have did in their completion process. So till that amount, they can recognize revenue. For example, see, if it's a contract for 2 years and the contract price is at 2 million. So for after 1 year, they have their progress can be determined based on the amount. If they covered 1 million, then that 1 million can be recognized in the first year as the revenue. Okay. So here the standard says ways in which consideration from the customer is present in the financial position. See, this is specifically for the satisfied over time. Okay, so we have already covered the satisfied at point in time, and in the below section we are seeing only the satisfied over time. So let's assume we recognize the revenue, and what is the other side of the journal entry? We need to know what is the other normally. What is the other side of the journal entry for journal entry for a revenue? That will be debit receivable and credit revenue. So we will credit the credit revenue that is generated or earned, and then we will debit the receivable. That is what he is saying. It is the normal process. See, if the entity's right to consideration is unconditional, see, it's very important. Unconditional, it should be recognized as a receivable. And in normal sense, we can see revenue that has been invoiced is receivable. So whenever the entity's right to receipt of the consideration is unconditional, they can recognize the revenue. And on the other side, they can post it to receivable. So in the statement of financial position, that revenue will be shown as a receivable till when it is received in cash or in any other method. That is the first way of recognition of the consideration. And the second method is contract liability. Very important, very important, very important that the terminology and the treatment that we need to have an understanding about how in terms of revenue recognition. So what is a contract liability? If a customer pays the consideration before the entity transfers the goods or services or satisfies the performance obligation, that receipt of consideration, see, that receipt of consideration should be accounted as a contract liability. Which means, for example, before you transfer the asset or a good to a customer, or before you complete the construction of the product, what they are saying? They're saying is that we need to recognize that consideration as a contract liability because it is a liability to us. Why it is a liability? Because we didn't do the work of the amount that we received. So till the date of our work has been completed or our performance obligation has been done, it has to be taken to contract liability. That's why it is here saying once the entity transfers the goods or services and the customer obtains the control. See, once the obligation is satisfied and the customer obtains the control, then contract liability need to be de-recognized by recognizing as a revenue. So only once we completed our performance obligation, we need to recognize that amount as a revenue. See, once you see the journal entry, you will have a very good idea. See the journal entry. Journal entry at the time of receipt of consideration. That is, we need to pass whenever the cash come in, we need to debit cash and credit the contract liability. And once the customer obtains the control or when we satisfy the performance obligation, we need to reverse that contract liability, thereby recognizing revenue. Then we need to debit the contract liability because it is a credit. The liability is a credit, so we need to debit by reversing the contract liability, thereby crediting the revenue. Got it? Okay. And one more, and then we can move to the next kind of term that we use in the statement of financial position, which is very similar to receivable. Very similar to receivable. And here what is they are saying is a contract asset happens if the entity's right to consideration is conditional. If there is a condition for the entity to receive the revenue, it should be recognized as a contract asset. In very simple sense, but we can see revenue earned but not invoiced. So when the whichever part of the revenue is not invoiced to the customer, that part of the revenue is considered as a contract asset. So this is a line item that we need to show in the profit statement of financial position. Don't mix up with the contract asset with receivable. In simple sense, receivable happens when the revenue has been invoiced. Contract asset happens whenever the revenue earned but not yet invoiced. So in non-invoiced part should be contract asset and the invoiced part would be receivable. And let's see the journal entry. Journal entry for revenue earned but not invoiced. What we need to do, we can recognize revenue, but we need to show it as a contract asset. So the entry would be debit contract asset and credit revenue. And once it has been invoiced, what will we do? We have to de-recognize the contract asset. That is by recognizing revenue. So the entry will be, we will debit the receivable because it is an asset, and then we credit the contract asset. That is also an asset. I believe you got the idea about three terms. That is receivable, contract liability, and contract asset in theoretically. And we will do a question which is related to contract asset. Then you will get the more understanding. We can do the fifth question. So let me read out the question first. James Company entered into a contract to build an office building for a customer commencing on 1st January 20x5 with an estimated completion date of 31st December 20x6. See, the inception date is 1st January 20x5 and the completion date is 31st December 20x6. Control of the asset is passed to the customer as the construction takes place and the James Company does not have an alternative use of the asset. See, satisfaction of performance obligation is measured by reference to work completed to date. That is satisfied over time that we have discussed. In the first year to 31st December 20x5, certificate of work completed has been issued to the value of 750,000. So the certificate of completion, that is progression of completion is 750,000. And the final contract price is the 1.5 million. So this is the total contract price. And in the first year, they did the work of 750,000. And the third one is amount invoiced to customer as at 31st December 20x5 is 625,000. See, so till 31st December 20x5, they have only invoiced up to 625, and no payment has been received in respect of the receivable at the year end. And what is our requirement? What is the amount of revenue recognized in the statement of James Company at 31st December 20x5? That is the first year. And what entry would be made for the contract on the statement of financial position as at 31st December 20x5. So it seems like a big question. No need to worry. It is very easy to understand. See, after we done the solution part, you will see it is very easy. See what happened. Our first requirement is the total amount of revenue recognized in the financial statement for 31st December 20x5. So what they have said, the completion of work till date is valued at 750,000. So how much is the revenue? It is very straightforward. Total of the contract price is 1.5 million. Out of that, 750 they have already performed. So revenue that need to be recognized is same 750,000. See, very simple as that. And what about the question is not ended at the revenue. We need to move on with the next requirement. They're saying what entries would be made for the contract on the statement of financial position. So see, revenue is part of financial statement of profit and loss. They need to know what is the figures and the entries that need to be passed in the statement of financial position. See, from these four points, we can identify that the amount invoiced to customer is 625. In our question, we saw that how we can recognize the revenue as receivable. Revenue that has been invoiced is receivable, and the revenue that has been not invoiced need to be taken to contract asset. You're able to differentiate it, right? So the amount is contract asset would be equal to we have 750 minus 625. 625 is the amount that we recognize invoiced. So this will be the contract asset, and the revenue receivable will be equal to 750 revenue minus our contract asset. 625 would be our receivable. So the entry would be debit receivable as 625 and debit contract asset at 125, and the total revenue need to be credit. Why we credited it? Because they said no payment has been received till date. So that will be contract asset plus receivable, that is 750,000. We can check the revenue. Check. See, 750 we identified minus the 750 above. See, 0. We get the answer. I believe you all got the understanding about how we can identify the revenue, right? So we come to the end of this session. So we need to identify. We need to have a very good idea about this 5 steps in order to recognize the revenue. I hope this session is a session would be given you a very good idea or knowledge about how we can recognize the